Many people shy away from investment because they think it is complicated. Others think they might lose money in investment. But the big question is, how does successful investors do this? I strongly believe that they play by certain guidelines. They play by certain rules and regulations. If you want to know more about these rules, then keep watching the video. In this video, I am going to share with you 5 golden rules that you can follow when it comes to investing. It will help you make an informed decision concerning your money. So make sure you watch the video till the end and watch out for my pro tip at the end of the video when it comes to investing. If today is your first time on the channel, my name is Bright Sarah Magbenyo. You can call me The Business. I talk about personal finance, personal development and entrepreneurship. If this interests you, then subscribe to the channel and put in the comments that you have subscribed. I will reply to all comments. Investing can help you meet your financial goals, and the better investment decisions you make, the higher your chances of succeeding. While nobody can make the best investment decisions every single time, following these 5 golden rules could help you make the best out of your investment over the long term. Rule number 1. Prepare the grounds for investing. You need to set the foundations. You need to put certain things in order to have a fruitful investment. Here are some steps to take in order to get your day-to-day money matters sorted before you begin this journey of investing. Starting to invest early can give you some room to grow over the long term. However, you need to set some foundations right before you begin to invest your money. Keep some money for emergency situations. Having some money set aside to sort yourself out or to help you deal with life's ups and downs can help you invest successfully without dipping your hands into your investment. If you have to go and dip your money into investment anytime you have an emergency situation, this will disrupt your investment and you will not be able to achieve the goal to why you started that investment. Clear any debts you have. I'm not trying to say you can't invest if you are in debt, but what is the point if the interest rate on your debt is more higher than the interest or the profit you earn on your investment? Then it means you are virtually doing nothing. So it will be better to clear the debt that you have so that you have a clear mind to focus on your investment. This whole topic of investing and dealing with debt is something we need to go into much deeper. So be on the channel and I'll do a whole video on that, on how to deal with your debt and investing. Get your day-to-day money in order. This implies that you need to know the ins and outs of your income and your expenditure so that you'll be able to decide how much you can comfortably invest on a regular basis. The consistency in investment is very important. If you have a lump sum that you invest once and watch it grow or watch it gain profit, that's fine. But if you don't have a lump sum to invest and you are someone who is going to be investing little amount on regular basis, then consistency is very key. This is why you need to know how much you can comfortably invest. It is important to know how much you earn, how much you expend, and then decide how much you can comfortably invest on a regular basis to achieve your financial goals. Finally, set your investment goals. Be clear on what you want to achieve, within what time frame, and write it down, right? This will help you create a mental picture of your investment or your financial goal so that you'll be able to contribute towards this goal. Imagine going somewhere and you don't know where you are going. How would you be able to know if you have gotten to your destination? You will definitely not know. This is why you have to be clear on what you want to achieve with your investment, so that you know you are working towards a target. If you know what you are targeting, you'll be able to measure your progress along the way. Rule number 2, know what you are getting into. Before you start any kind of investment, you need to do your research, what we call due diligence. You need to do this to know if you understand the investment you are choosing for yourself, and is it worth your risk appetite? Are you able to take the kind of risk that this investment you are choosing poses? If this works for you, then it is absolutely good for you to do. Your risk appetite is how much risk you are willing to take when it comes to business, when it comes to investment, or when it comes to any form of endeavor. So you need to know if the kind of investment you are choosing, you understand it and it matches your risk appetite. Make sure you know things like the level of risk you are taking, the factors that are likely to affect the performance of your investment, and how easy it will be to get your money back if you need it. If it seems too complicated to understand, then you would want to steer clear of it. As a rule of thumb, speak to any financial advisor before you make any major financial decision. Rule number 3, diversify. As the popular saying goes, don't put all your eggs in one basket. Diversification helps cushion you against major losses, and it is one of the most important keys when it comes to investing. As much as possible, diversify across different asset classes, different companies, different markets, and different geographical locations. This is why most people would like to invest in things like the S&P 500, which has a pool of companies. So if one company is not performing well, the other might have been performing, so it creates a balance. Rule number 4, hold your investments for the long term and contribute regularly. This can be monthly, it can be weekly, it can be quarterly, anyhow you want it, you can choose it. The most important thing is to be consistent. In investing, the longer you stay invested, the higher your chances of significantly growing your profits. Instead of timing the market to exit and re-enter whenever there are fluctuations, it will be better to stay invested so that you don't lose as much as possible. Investing over a time frame of at least 5 years gives you more opportunity to ride over any short-term dips that may occur. That is, if your investment is not performing at a particular time, but you decide to invest for the long term, there are times that it will perform very well and it will cover up for the dips that have already occurred. It is quite obvious that the one that plants more seeds should expect to harvest more. Committing to daily, weekly, or monthly deposits of even little amounts are more beneficial and sustainable than waiting to invest a huge or a lump sum. Rule number 5, keep on top of your investments. It is a good idea to periodically review the performance of your investments. Choices that were good and right for you 2 years ago might not necessarily be the best for you now. As to whether you choose a private financial advisor to review your investment and its performance, or you do this by yourself, it is always important to review your investment choices regularly. Take stock of your investment performance. Some of the investments you are holding might have performed than others, so you want to review these things and see if you want to invest more towards the ones that are performing well and stay away from those that are underperforming. But still, you need to consider the risk that are posed by these various investments. One important reason why you also need to keep reviewing your investments is because your objectives might have changed over the period. You might have achieved some and underachieved some. So you want to review and restate your objectives and readjust how you invest to achieve these objectives. Now, my pro tip: don't be swayed away by high returns. Every successful investor knows that usually in investing, the higher the returns, the higher the risk. So instead of investing simply because of high returns, rather check out for the risk involved and the track record of this investment so that you don't end up losing money in any fraudulent scheme. We have been talking about the 5 golden rules that the most successful investors follow to get the best out of their investment. These are: set the foundations right for investing, know what you are getting into by doing your due diligence, diversify as far as possible, and keep on top of your investment by regular reviews. If you found these rules helpful, or you have any additional ones that I haven't mentioned that help you make even better investment decisions, feel free to comment below so that we keep learning from each other to build the wealth we want. I'm grateful you have watched this video up to the end. If you haven't subscribed yet to the channel, please subscribe, like the video, comment and share to your friends so that this knowledge reaches a lot of people.